Hopefully our video won't sound too much like an economics lesson, but we've decided to do it on two different topics. Ashley and I are going to take a look at the President's proposed corporate taxes, while Chelsea and Rachel are going to talk about the proposals on the capital gains taxes. I'm going to turn it over to Ashley so she can start.
So currently, when a U.S. corporation has a foreign-controlled corporation, the earnings from the foreign company aren't taxed in the U.S. until the foreign corporation pays a dividend to the U.S. corporation, and then it is taxed at 35%, which is just a flat tax. So Obama has proposed that there is a one-time 14% tax on all that unrepatriated foreign earnings. There's an estimated $2.1 trillion, so the tax would bring in approximately $238 billion over the next 5 years, which would be used to rebuild our infrastructure and replenish the highway trust funds. In addition to the one-time 14% tax, the tax would be reduced from 35% to 19%, and that would just be on the foreign earnings whether they were brought back to the U.S. or not, so there wouldn't be an additional tax when they brought it back in. This would help raise tax revenue for us and lower the tax rate for corporations.
One of the things that I found interesting, a 2011 study from the World Bank, which at the time had 182 members, the U.S. for taxes, corporate taxes, was ranked at 124, putting them in the top half of the highest countries for tax rates. The one concern I would have about these taxes is if there is an actual increase as opposed to a superficial decrease, and would the companies that operate multinationally would have more of an incentive to move their corporate incorporations outside of the U.S. And now we're going to turn it over to Chelsea so she can start on the capital gains.
Taxpayers in the 39.6% tax bracket are taxed on long-term capital gains at 23.8% and qualified dividends at 20%. Under the new proposal, long-term capital gains and qualified dividends will both be taxed at 28%. This is an increase in the long-term capital gains rate of 4.2% and an increase in qualified dividends rate of 8%. This could have both positive and negative effects on the economy. The 28% rate on both long-term capital gains and qualified dividends is still a preferential treatment for these items, since the taxpayers being affected by the increase have to pay 39.6% on ordinary income. The lower rate of 28% is still over 10% less than what they pay on ordinary income. And additionally, this new tax will raise an estimated $320 billion in funds, and this will be used to support more tax breaks for the middle class and will be used to help fund free 2-year community college. This will help a larger percentage of taxpayers than those harmed by the rate increases, as well as helping to educate more young adults.
On the other hand, studies show that when tax rates on capital gains increase, investors are more likely to hold their assets as opposed to selling them in order to avoid the higher tax rate. Thus, higher tax rates often result when tax rates decrease because more people are willing to sell those assets. Many tax laws are designed to help lessen the burden of double taxation on shareholders. One of these methods is allowing lower tax rates on dividend income for shareholders. By raising the tax on qualified dividends, this is increasing the effects of double taxation. Shareholders that choose to hold their investments in order to avoid the higher capital gains tax rates will be forced to pay a higher rate on the dividends they receive. This could cause more tax planning in order to figure out if investments should be held or sold. Both of these topics are being proposed in Congress right now, and it's just a matter of time to see how they will play out.